Glad you're here. If you are 65 or older, you have an IRA or a 401k. You have been managing carefully. Congress just handed you a tax break worth up to $12,000 off your taxable income. It is brand new. It started with your 2025 return, and you do not have to fill out a single extra form to claim it. Here is the part almost nobody is telling you. There is an income trap built into the very same law, and the move most responsible retirees make with their own retirement account is the exact move that can quietly erase the whole thing before you ever see a dollar of it. This is real money, not a rounding error. For a married couple where both spouses are over 65, this new deduction can cut around $2,600 off your tax bill every year it is in effect. It runs for 4 years, 2025 through 2028, and then it disappears. That is more than $10,000 over the life of the break. Think about what $10,000 is in your house. It is roughly 14 months of groceries. It is about a year of Medicare premiums for 2 people. For thousands of retirees, every penny of it is going to vanish because of one withdrawal they never knew was working against them. By the end of this video, you will know exactly where the trap is, the single number that decides whether you keep this deduction or lose it, and the one legal move that protects it. Before we get into it, take 1 second and subscribe and turn on the bell. The tax code changes every year, and when it changes, the IRS does not send you a letter explaining what it means for your money. They write the rule, and they expect you to already know it. This deduction is a perfect example. It is brand new. A lot of preparers are still catching up on it. The income trap inside it has gotten almost no attention at all. What I do on this channel is read the actual provisions and tell you what they mean in plain English before the deadline passes and the chance to act is gone. So let's start with the good news, because it really is good. The law is called the One Big Beautiful Bill Act, signed in 2025. Buried inside it is something people are calling the senior bonus deduction. If you are 65 or older, it knocks an extra $6,000 off your income before the IRS ever calculates what you owe. If you are married and you are both over 65, that is $6,000 each. $12,000 total. Now, a lot of people hear the word deduction and assume it only helps you if you itemize the way you would with mortgage interest or big medical bills. That is not how this one works. This deduction sits right on top of your standard deduction. You take it whether you itemize or not. For a single person over 65 in 2026, your regular standard deduction is $16,100, plus the older existing senior add-on of about $2,000, plus this new $6,000. Stack those together, and it is more than $24,000 of your income. The IRS simply does not tax. For a married couple both over 65, the total climbs past $47,000. Here is one more thing about it that matters, because it changes how much this is actually worth to you. This is a deduction, not a credit. Credit is a flat dollar knocked off your tax. A deduction lowers the income you get taxed on, so what you save depends on your tax bracket. The 12% bracket, that $12,000 deduction saves a couple about $1,400. The 22% bracket is more like $2,600. The higher your bracket, the more the deduction is worth, which is exactly why losing it hurts the people who saved the most. So where is the catch? Because there is always a catch, and on this one it is sharp. This deduction is not promised to every person over 65. It is tied to your income, and the way it is tied is the entire reason this video exists. Here is the number that decides everything. The IRS looks at something called your modified adjusted gross income, your MAGI. Think of it as nearly all the money that hits your tax return in a year. The part of your Social Security that gets taxed, your pension, every withdrawal you take from a retirement account, all of it added up. The senior bonus deduction starts vanishing. The moment that number crosses $75,000 if you are single, or $150,000 if you are married filing jointly. And it does not fade gently. Every dollar over that line claws back a piece of the deduction until at 175,000 single or 250,000 joint, the entire thing is gone. Zero. Here is what makes this a trap and not just a rule. The income that pushes people over that line is almost never a windfall. It is not the lottery. It is their own retirement account, doing exactly what the government told it to do. Let me show you how. At 73, the government forces you to start pulling money out of your traditional IRA every single year, whether you need it or not. This is the required minimum distribution, the RMD. On a retirement account of, say, $600,000, that first required withdrawal is around $23,000. You did not ask for that money. You may not even want it, but it lands on your tax return as income. It counts toward your magi, and it can be the very thing that shoves you over the line and starts erasing your deduction. Now here is the part that catches the most careful people of all. Say you have been doing everything right. You have been making Roth conversions, moving money out of your traditional IRA into a Roth, so you owe less tax in the years ahead. That is genuinely smart planning. But every dollar you convert counts as income in the year you convert it. So the move you made to lower your future taxes can push your magi over the threshold this year and wipe out a deduction worth thousands. You did the responsible thing. The responsible thing is what cost you. Let me put real numbers on it so you can see how fast this happens. Picture a single filer, 71 years old, with about $46,000 of income from Social Security and a required withdrawal. At that level, they qualify for the full $6,000 deduction. Now they do a $35,000 Roth conversion. That lifts their magi to $81,000, $6,000 over the $75,000 line. The IRS shaves about $360 off the deduction. Annoying, but survivable. Now suppose they convert $50,000 more on top of that. Their income is now $131,000. They have lost more than $3,000 of the deduction, and they are keeping barely a third of what they were entitled to. Same person, same account. The only thing that changed was a number they did not know they were supposed to watch. Now you might be thinking, if this is my deduction, how can my own money disqualify me from it? Fair question, and here is the honest answer. The law does not measure whether you deserve the break. It measures one thing, your income for the year. And the system cannot tell the difference between a retiree who got rich and a retiree who simply followed the rules and took a withdrawal the government required. To the formula, a dollar is a dollar. That is the design. That is why nobody is going to warn you and why the line is yours to watch. Here's the part that actually protects your money, and it is the reason this matters today and not someday. The escape is hidden in the same tax code that set the trap. It is called a Qualified Charitable Distribution, QCD. Here is how it works. In plain terms, if you are 70 and a half or older, you are allowed to send money straight from your IRA directly to a charity. The key word is directly. The check goes from your account to the charity and never passes through your hands. Because it never touches you, it never shows up as income on your tax return. It does not land in your magi at all. It gets better. That transfer also counts toward the required withdrawal the government makes you take. So the exact dollars that would have pushed you over the line and erased your deduction, instead leave your account quietly, satisfy your RMD, and keep your magi sitting underneath the threshold where the deduction lives. You can move a large amount this way each year, well over $100,000 per person. So for almost everyone watching this, the entire required withdrawal can be covered. One detail here can trip up even a good preparer, so know it. The transfer has to be reported correctly. On your tax return, that money should show up as a distribution that was not taxable, marked as a QCD, not buried as an ordinary charitable write-off. Tell your tax person you did a qualified charitable distribution and make sure they record it that way. Done right, that income simply never appears. Now, you might be thinking, this only helps people who were going to give to charity anyway. Fair, But if you already give, even a little, to a church, a food bank, a hospital, anything at all, and you are writing those checks from your regular bank account, you are doing it the expensive way. Route that same giving through your IRA as a QCD instead. You protect not just the tax on that gift, but potentially the entire senior bonus deduction sitting behind it. Same gift. Completely different result on your taxes. If you are not yet old enough for the QCD, there is still a lever in your hand. If you are doing Roth conversions, size them on purpose. Before you convert, add up the income you already expect that year and see how much room you have. Before you hit $75,000 single or $150,000 joint, convert up to the line, not past it. The conversion is still a smart move. It just has to be measured against this threshold now, the way it never had to be before. One more thing, and it depends on where you live. This is a federal deduction. It lowers what you owe the IRS, but your state may not go along with it. Some states calculate your state income tax starting from your federal income and will not automatically honor this new federal break. In Florida and in Texas, there is no state income tax at all, so the federal benefit lands clean, with nothing to untangle. In a state like California, the state historically does not follow many federal tax changes on its own, so you could get the deduction on your federal return and not on your state one. The answer is different in every state, and it is not automatic. Search your state name and the phrase ABA conformity, or call your state revenue department and ask them directly whether they adopted the senior deduction. Let me show you how this plays out for a real couple. Earl Patton is 68, a retired civil engineer in Ohio. 34 years at the same county infrastructure office. He paid the house off back in 2019, made the last payment 3 months early, and he has never carried a balance on a credit card in his life. His wife, Barbara, 66, retired school librarian, runs their accounts. Between them, they have about $680,000 in an IRA and around $42,000 of income a year. They did everything right. In December, Barbara is reading the tax summary. Their CPA emailed over, and 4 paragraphs down, she finds it, the new senior deduction. $12,000 off their income, about $2,600 back in their pocket every year. She is thrilled, and she should be. Then their advisor suggests something that sounds completely reasonable. Earl is 68. His required withdrawals do not start until 73. This is a perfect window. The advisor says to do a big Roth conversion now and shrink those future withdrawals. He floats converting $115,000 this year. On its face, smart planning. But that conversion lands as income. It lifts their magi from $42,000 all the way to $157,000 past the $150,000 line, and it quietly starts eating the very deduction Barbara just found 2 paragraphs back. They would have paid for it and never connected the 2 events. Here is the turn. Because they caught it, they sized the conversion down to keep their income just under the line, and they kept the full deduction. And in a couple of years, once Earl turns 70 and a half, the giving they already do every year will run straight out of his IRA as a QCD, so when his required withdrawals finally start, that money never threatens the deduction at all. Same plan, same goals. They just stopped letting their own good decisions trip the wire. So let's bring it all together. The One Big Beautiful Bill Act gave anyone 65 or older a brand new deduction, $6,000 per person, $12,000 for a couple, and it runs only through 2028. The action there is simple. Make sure your tax preparer is actually claiming it for you, because it is new and easy to miss. The trap is the income line. Cross 75,000 single, or 150,000 joint, and the deduction begins to disappear, gone completely by 175 and 250,000. The action there is to know your magi before the year ends, not after, when nothing can be changed. The escape, if you are 70 and a half or older, is the Qualified Charitable Distribution. Send your giving straight from your IRA. so it never counts as income and never threatens the deduction. And make sure your preparer marks it as a QCD. And if you are younger than that and converting to a Roth, size every conversion against that threshold before you sign off on it. None of this comes with a warning label. The IRS will not tell you that the withdrawal you took or the conversion you made just cost you a deduction you were entitled to keep. You have to know the line is there and stay under it on purpose. Before your next withdrawal or conversion, run the number. If this helped you, subscribe. Send it to someone over 65 with an IRA, a parent, a neighbor, a friend. One conversation could save them thousands. I'll see you in the next one.